Welcome to Share Talk, the only podcast where investors come first.
Hello and welcome to Share Talk. Today I'm joined by Mike Ingram, who's an independent market strategist. How are you today, Mike?
Very good, Zach. Hope you're well.
I'm very well. I'm hoping that this week the central banks will be very well as well. Is that a fair thing to say?
Yeah, so we had a little bit of a warm-up act from the ECB last week, and what they said was they're going to effectively front-load their quantitative easing purchases, so that's going to help to settle bond markets in the Eurozone. You have to say that, frankly, compared to the fallout we've seen elsewhere, it has actually been pretty muted. This week, we've got some of the other heavyweights weighing in, if you like. We've got the Fed on Wednesday, we've got the Bank of England on Thursday, and then we've got the Bank of Japan on Friday. When with earnings season largely died down, and a lot of focus is going to be on these three central banks. As I said, particularly on the back of some of the really violent reaction we've seen in the bond market, and the overspill we've seen into currencies and equities and elsewhere.
But how important is the bond market in an age of QE and helicopter money and confetti money and stimulus checks and everything else? Isn't it just totally irrelevant now?
I think the point can be validly made, and goodness knows I've made it for several years now, that with all the central bank tinkering we've seen for the last, 12, 13 years now, you've got to question how meaningful some of the numbers coming out of the bond market actually is. In that respect, actually, the whole policy of QE is somewhat self-defeating, because if you say, well, we're going to cap the bond market prices, at such and such a level until we see inflation, well, really, how would you know? Certainly the bond market, which you're at that point actually manipulating, is likely to give you at best very, very distorted signals. So, if you look at the moment at what the bond market supposedly telling you in the US, the so-called 10-year break-even inflation, which is basically the inflation you'd actually get, so that the yield you get on nominal bonds and TIPS, Treasury inflation protected bonds, is the same. It's 2.2% and going up. So the Fed's had a 2% inflation target for quite some time. Last year they tweaked it. They said, well, we're going to go for average rather than inflation at any point in time. But on the face of it, you could say, well, mission accomplished, and yet you still got a situation where the Fed is at the moment, it might change on Wednesday after the press conference, but at the moment they're saying, no rate rises at least for another couple of years, and the bond market to a large extent is thinking maybe not even 3 years. So how do you reconcile those facts? You probably don't.
I'm saying is if the bond market's got interest rates rising, but in fact the Fed would never raise rates, or the Bank of England or nobody else would ever raise rates, it's irrelevant what the bond market is saying.
Yeah, so I don't disagree with it. As I said, there's a large element to which it's self-defeating. The bond market on the face of it, as I said, at the moment is kind of indicating that inflation expectations embedded in market price, and I use the word market in inverted commas clearly in this case, is actually saying, well, you've already got there. You've already got to 2% high, and yet the Fed's saying, we're just going to plow on. But, having said that, it is at least significant in as much as we can see that the bond market is moving other markets. It's moving currencies. Look at what's happened. Look at the rise of yields in the US. Look at the impact, for instance, that's had on, between the cross of the Japanese yen, for argument's sake. That's gone parabolic. Similar kind of situation against the Aussie dollar, which is another one of these sort of inflationary canaries in the coal mine. The thing is, let's be honest. A lot of this is about rising inflation fears, and if you put it in the context of the pandemic, which hopefully is winding down at this point, both the US and Australian economies took relatively small hits. I'm not saying it wasn't significant. It was, but I think the US GDP was down 3.5% last year. Australia 2.5%. In the UK it was nearly 10%. And both of those economies, both the US and Australia, were running hot going into this. And certainly in the case of the US, there's just been another enormous amount of stimulus. Lots of budgetary spending financed by the central bank, thrown at the economy. So the idea that yields sub 1% are appropriate in that kind of environment. I mean, they're kidding themselves, quite frankly. And actually, if that were to happen, if that were to happen, sort of Japan type scenario, this Japanification of the global economy, then actually, you probably should fall in the towel, because at that point in time, your economy is going to collapse, and we can all be trading bitcoins or whatever until it's coming out of our ears. But no, frankly, at that point, you should probably be buying ammunition, some fairly strong alcohol, and be looking to try to size up caves in Wales or wherever, because if that actually is an indication of where we're headed economically, then it's pretty dark indeed.
Well, send your regards to the good people of Wales. But isn't it the case that I went to the LSE for 6 weeks, so I know more than 99% of economists. We had the GFC in 2008, which was in effect a massive deflationary event. The pandemic has also been a massive deflationary event, and an ongoing one. And basically, the central banks and the governments would have to issue trillions in stimulus in order to counteract the deflationary effect of the pandemic. So the $2 trillion nearly that Biden's approved, it won't even be a drop in the ocean compared to the negative effect and the deflationary effect of the pandemic.
Well, I think you've got effectively a sort of a complete bipolarity in this, yeah? So you're talking about inflation and reflation and so forth. I would take the case that, if you go back to the immediate post, GFC, global financial crisis environment, I think it was absolutely right that policymakers, fiscal policymakers who control budgets, and monetary policymakers, central banks who control interest rates, should step in to cushion the blow, because that was a systemic, profound impact on the global economy, and effectively it was an economic defibrillator. Yeah, it's helped to jumpstart activity. The problem was, in my view, and I'm not entirely being, got my hindsight goggles on, because I was writing about it at the time, so that the time never came to say, well, hang on, let's get rid of some of this stimulus and let's try and make this market clear itself properly. And they never did. I mean, actually, I think ironically, we'd have been in a better position if they raised interest rates a number of years before they did, and some of the malinvestment, because all this liquidity has got to find a home. Yeah, and as I said, I think in previous broadcast with Zach, I mean, clearly
doesn't it find a very happy home in the 1%?
Well, exactly. And let's see how that pans out. I mean, politically, socially, economically, that is not going to end up in a good thing. So the thing is that just ends up going into sort of various forms of financial speculation, financial engineering. It does not go into the real economy, and ultimately it's the real economy that underpins wages, etc. Now, we can all go on, and don't get me wrong, great environment for traders, loads of liquidity sloshing around, loads of cheap funding, margin accounts, the occasional panic attack that you can trade around. Don't get me wrong, great. But it's fundamentally a road to nowhere. It's only productivity growth which actually powers long-term economies and makes them viable. It means that any of this stuff ever gets paid back. And I think it's no coincidence that since the great financial crisis, with all this tinkering we've had with from central banks and elsewhere, and of course that's been kicked into another gear entirely by the pandemic response, which, by the way, was a recession of choice to some extent, then this is all basically a game. This is all a game. Now, people are winning and losing in that game, but as you kind of indicated yourself, a lot of this has been through the so-called wealth effect. And surprise, surprise, the Fed actually quite recently released a piece of research, and why they had to research any of this is beyond me, quite frankly, but they came to the conclusion that to benefit from the wealth effect, you actually have to have wealth to start off with. So there you go. I mean, it's these policies are unsustainable. It's going to be interesting to see what, for instance, Jerome Powell, the Fed chief, is going to say on Wednesday, because I mean the market's waiting for him to talk up the bond market. They're very disappointed that he hasn't underwritten their losses effectively over the last few weeks. And he's in a real bind, because in one sense he could say, well, bond yields are up because it's our policies are actually working. It's actually doing what we said it would do finally, and getting the economy moving and getting inflation up. And then you have a whole bunch of people in the market saying, yeah, but we've lost money on bonds. What are you going to do about it? So yeah, it's going to be an interesting old week, I think.
Well, we look forward to it. Mike Ingram, independent market strategist. Thank you very much indeed.
You're very welcome.
Thank you for listening. Remember to visit our website for more news and other podcasts at www.share-talk.com.